let's continue with assessment of what we're seeing with the CBA and also the federal budget and implications for investors. We're joined by Darren Thompson from Equity Trustees. Darren, welcome.
Thank you. Good morning.
You've just probably been listening, or well, maybe not, but we've just had Michael Green talking about that index investing and the momentum we're seeing at the moment on markets and how it exaggerates those moves, and perhaps we've got significant structural issues to consider. But in particular, he mentioned CBA there, which has once again benefited from those passive investment flows.
I think you're absolutely right, and I did catch a bit of that, the last speaker's presentation, and I agree with a lot of the thrust of what he's saying. That essentially the active component of the investor pool has definitely shrunk over time, and a lot of structural forces, particularly around superannuation lift and your super performance tests, have led to the buying of the large caps. And I do think that has extended momentum across those pool of stocks. And you referenced CBA, certainly would agree that has been a key beneficiary, if you like, of that those market forces, pushing it up to still, even after yesterday's pullback, 24 times PE, 3.3 times book, just a meaningful premium to domestic peers and also global peers. So we do think that a large part of that rating has been due to market forces rather than fundamental valuations. Now the question is, when does that stop? Because I think whilst we're in accumulation mode and superannuation pools are continuing to grow, that does continue that thematic, and it's only when those stocks disappoint, but then you can, as I think he noted, get material volatility in share prices the other way if you don't have that valuation support. So we're certainly underweight CBA materially as a consequence of valuation, but it's been very painful over the last 2 years as that stock has performed very strongly in our portfolio.
Well, 10% falls yesterday. I mean, that is a huge leg down. Given how far it has run, do you think it has more to go, just in terms of you looking at fair value?
But I think this is the issue once momentum starts the other way. So after that 10% fall, as I said, it's still trading at a material premium, a 20% premium to its domestic peers. And whilst it has executed very well over recent years, and that premium has, just like a frog in boiling water, just tended to increase over time. So we do think it could fall another 10 to 15% and still not look cheap. So certainly, whether it will is another matter, but certainly valuation would suggest it does have further downside risk.
Now, Darren, given what we heard out of the budget, do you want exposure in the banks at the moment, particularly given the effect on the property market, perhaps how that's going to affect their loan portfolios and future demands? There are a lot of headwinds now emerging.
I think you're exactly right. The right term is headwinds, and I think the banks are well-run businesses. They have some positives attached to them in terms of potential for AI and other cost initiatives to take costs out of the business, but they are running at still very low levels of bad debts across the economy, and we do think the budget measures will slow already weakening credit growth, and obviously particularly to those banks like CBA, who has 40% of its mortgage book in investor lending. That, in our view, will slow that credit growth, and we do think it's a headwind for growth. So we're underweight the sector, as well as being underweight CBA. We're underweight the sector, and we do think there is better relative value elsewhere in the market. So you're also seeing that the banks have been just starting to see a slight uptick in credit provisioning. They've taken some economic overlays to increase provisioning across their books in recent weeks, as they've reported. And so as interest rates are likely to stay stickily high, as we see the energy pulse coming through into inflation, they are all adding to a sort of a less than favourable outlook for the banks.
Moreover, in the wake of the budget, assuming those changes are legislated, what other changes would you be making?
In terms of portfolio?
Yes.
Yeah, so what we do think at the moment is that those banking headwinds and capital is better deployed where overweight materials, and we do think that there's some countervailing forces in the world at the moment. There's weakening economic growth, which is usually not great for base metals and resource consumption, but there are also the AI thematic and build out around base metals. The energy transition is also very supportive. So copper and iron ore we still think are resilient. So materials is an area where we're certainly supportive. And we're also looking for basically less domestically focused businesses, more globally focused. So stocks like Macquarie, stocks which have been somewhat perhaps we think hit by short-term factors, stocks like PEXA, which have also been adversely impacted by a potential pricing review, plus also concerns about housing volumes, but where we think there are structural long-term growth coming through. So it's more stock-specific investments in industrials, materials from a sectoral level, and less exposure to banks.
Overall, there's an expectation that we're going to see greater inflows into the equity market as people perhaps bail out of the property market given those tax changes. Would you agree with that? And perhaps which area is likely to benefit?
Yeah, so I think that there's been a bit of talk that, at the margin, dividend and income-centric stocks will benefit as a consequence, and more capital growth-oriented stocks will be adversely impacted as the tax changes come through. So we would see that there is some incremental, the marginal dollar I think will go to stocks or be more favourable than property as a consequence if they're enacted, these changes. But I don't think it's a wholesale change. So where we're positioned is thinking that really the Treasury's estimate around slowing growth is probably the case, but with some downside risk as we start to see these inflationary impacts come through. We are a very property-centric, services-oriented economy. So we are more positive around some of the offshore markets, particularly the US, where productivity is higher, growth is higher. So that's where we're skewed a little bit less exposed to Australia and a bit more exposed to international markets, and particularly the US.